Hello, my name is Simon Appleyard, Regional Manager for Wesleyan Financial Services.
Hello, I'm Leyfield, Account Manager, also for Wesleyan Financial Services.
Welcome to today's discussion on the key aspects of GP partnership agreements and how they impact on personal and business financial planning. One of the most important elements of a partnership agreement is how it deals with absence, particularly due to illness. And I know, when we look at a practice, a multi-million-pound business, that up to 70% of the cost is still people. So on the one aspect, it's about what does the partnership agreement say for the individual, but also it is about what is the business impact, which also comes back to the individual. So what sort of things do you think need to be considered?
Start probably with thinking about it from a personal aspect. So think about as a partner. And you're absolutely right. In terms of financial planning, one of the most important areas that a partnership agreement should cover is outlining what happens if that partner falls ill. It explains what the liabilities they have individually and what liabilities each partner has to each other. And typically for a GP practice agreement, it'll say that partnership will cover the costs of any absence for a certain period of time. Probably the most common period is about 4 weeks. And then from that point onwards, any costs incurred will be the responsibility of the absent partner. Obviously for GPs, there's NHS support kicking in after a couple of weeks, 4 weeks in Northern Ireland, but 2 weeks in the rest of the UK. And that helps reduce that liability. But typically, certainly in parts of England and Wales, we're looking at £700-800 a day locum costs, £2,500 to £3,000 costs per week. So if the partnership agreement says those extra costs above the £1,700 odd pounds that the NHS will provide, that could be £1,000, £1,200, £1,300 a week for 6 months, rising to close to £2,000 a week for a full-time partner thereafter. So again, it's really, if you're looking at your partnership agreement, be aware of what it means in terms of your own personal liabilities. What does this mean to me and my family? And really importantly, understanding that actually the partnership agreement creates a bill for you that you've got to pay rather than drops off your income. The result's the same, but it's really important because you actually technically still receive all of your income and you're paying your pension contributions and your tax on your whole gross income, and then you've got this bill which takes a big chunk of it away. So making sure that whatever your circumstances, whether that's through insurance policies or through savings or whatever your plan is in place, the partnership agreement outlines what the risk is that you're taking on as a partner if you fall ill, and that enables you to plan based on your own personal circumstances. And I think I'd really stress the point that it's a personal solution you need, because a typical practice with 5 or 6 partners, the one thing I'll guarantee you is there's 5 or 6 completely unique sets of personal circumstances. And you can't always take a uniform approach. Sometimes we need to tailor that around the individual needs of certain partners. And the risk of a 35-year-old partner with a young family and 30 years from retirement can be very different from somebody approaching 60 who's got the option to use their NHS pension if they fall ill. So again, give you an example of that. But it's the partnership agreement which outlines what that liability is. So that's hugely important for the individual, but we often talk about the thing which is so often overlooked, and you touched on it there, that a GP practice is different from many business in that the income is largely fixed. The costs are the variable, and as you say, most practices we estimate anything up to 70% of the money going out of a practice goes out to the people within that practice. It therefore follows that the biggest risk to that gap narrowing is increased costs of keeping those people. And absence is one of the biggest risks of that. I know that you've got some thoughts around that and how that might impact for key roles.
Yes, I mean, as we've touched on, the point is if you've got, as you increasingly do have within primary care, a greater reliance on other roles as opposed to a strict GP partner being the primary point of contact for a patient. You are looking at nurse practitioners, you're looking at other roles within that business, and practice managers are absolutely fundamental to running of the business. These are roles that command cost in terms of you've got to pay good money to get good people, and therefore you've also got to have good terms and conditions to look after them if they are off themselves in terms of sick pay. So the potential liability there for an individual partner is significant. And particularly as these roles are for generally more experienced individuals, and therefore statistically they are more likely to go off. So it is whilst you might be reducing the overall cost of the people in your business by not employing GPs and having nurse practitioners, for instance. The risk of them still impacting upon your bottom line is significant. And that always, you therefore have to draw that line straight into your family's income, because that's where it hits. So you might be fine if you have an ill partner, or if you have an ill member of staff. There is the potential for that to have a significant impact, no matter how healthy you are as an individual. The other thing that I note is that we quite commonly, people do recognise the need to cover themselves for income protection, i.e. when my drawings stop, I need to make sure there's something there to replace that. But not always, as you said, to look at what's the personal situation before then, because that locum bill, or that cost, as it might be, comes before you lose your income. It's going to hit you first, and potentially hit you hardest, even with the support.
Absolutely.
And remembering, as you said, that the support that you get from the NHS at the minute is for GPs only, not for these additional roles. And I think one of the things I quite commonly see is within the function of a practice agreement is that where there's been a weak section on dealing with conflict, where you've had someone who's been sick and it's been off a long time and it's caused a problem, what we so often see is the solution to that is to actually change the partnership agreement so that it encourages people that they don't get their drawings for so long. Okay, well, we'll only pay you for 6 months, and right, there we go. And actually, what you're doing there is you're swapping. If it happens to be you, you're swapping a more expensive problem to solve, your income protection, as opposed to having a potentially easier to deal with solution of protecting the liability for that 12 months. So I don't want to go too technical on that, but instead of having a good, robust, we're going to deal with the problems of within the partnership agreement, that's why it should be in there and reviewed, they kind of leverage it to duck that, but actually cause themselves potentially a real problem in their own family income later.
I think it's a really interesting point, and one that I personally have seen on a number of occasions over the last 10, 15 years, of partnership agreements being amended to react to a situation that's happened previously. And I think I'll repeat the one that you mentioned there, which is where typically a partnership, one thing that will be in pretty much every partner, should be in every partnership agreement, is how the partnership would end, if we're talking about ill health, have that sort of mandatory retirement phase. And typically it's 12 months is the most common. But you do see partnership agreements. I've certainly had discussions with practices where they've reduced that down to 6 months, as you've said, and you explore why. And often the examples I'm thinking of, multiple examples, are situations where they've known very early that the absence of a partner, that partner was never coming back, and they can be incredibly serious illnesses. But because that partner is entitled to take their share of profits and the mandatory retirement doesn't come in for 12 months, it's meant that they've not been able to move in their move the business on, take new partners on until the end of that time. So the reaction has been, we'll amend the partnership agreement and we'll bring that into 6 months. I've seen 3 months as well. But actually, the interesting bit is the people that then are affected are the people that are writing that partnership agreement, because you're reducing your own family's security that 12-month period and taking that risk on yourself. So actually, my partnership can be terminated after 6 months now. I need to make sure my personal income protection planning kicks in at 6 months rather than 12 months. You don't get rid of the problem, you've just shifted it from a partnership one to a personal one. So again, talk about these things both in terms of financial planning to specialist advisors, but also talk to the specialist solicitors about the wording of it. What are the implications? And the two overlap. Your solicitor will write your partnership agreement, as you say, make sure that it does the things you want to do. Don't forget the financial planning aspect of, well, if we change this, what does this mean in terms of our personal planning for us and our family? That would be hugely important.
I couldn't agree more. And if you were to actually encapsulate what we do for GP partners, clients, is we interpret, what does it actually mean for you and your personal goals in life? What does this mean? And that's so powerful, because that's how we can help people. And I would also say that bit about when does the partnership agreement say that drawings stop is really key. And a classic example of what we touched on before, a 35-year-old with a young family and a big mortgage definitely wants to have 12 months. An older partner who might actually, do you know what, I'm going to go off. If I'm going off, I'm probably just going to take early retirement. Would much rather see the risk to them as reduced by reducing it down to 3 months worth of drawings. So it's something always to keep an eye on. What does this mean for an individual? Because it is either a personal solution or it's a renegotiation of the partnership agreement.
But a point that we've made throughout these discussions that we're having is the partnership agreement sets out a certain set of rules. There is absolutely nothing that with the agreement of the partners in the practice that something different can be done. So a partner who wants to end their partnership earlier, if everybody agrees it can be done, because the partnership agreement says that the partnership will continue for 12 months. Doesn't mean that with agreement you can't do it earlier. I'd question why you would want to, but there might be circumstances where that happens. Thank you for watching our video today. Hope you found it interesting. At Wesleyan Financial Services, we're specialist financial advisors to GPs and GP practices. So if you have any questions and would like to find out more about how some of the topics we've talked about might affect you, please visit us at wesleyan.co.uk.